I think the FTX scenario, first of all, horrendous for investors that are losing or have lost their money. But I do also think it was the kick in the pants, if you will, that the regulators in Washington needed to get something on the books. When you get that many people to get hurt, and also big money got hurt, which is kind of the first time I would say that institutional money really took it on the chin. And so I think that that's also going to push for regulation. And I think this is going to be the best. I know everyone was against it when crypto was rocking, but this is why you need regulation. You need rules. You need transparency. Otherwise, unfortunately, there's always bad apples that are going to do shady things and end up robbing people. So we get that regulation in the door. And then once you have transparency, big money can actually invest knowing it's somewhat safe, right? It's still the investment. It's still risky investment, but at least they're not going to get their money stolen. So I think that's the key there. It's really a crazy scenario, but I liken it to the Lehman Brothers collapse. The Lehman Brothers collapse in 2008, because again, very similar in Lehman wasn't doing shady, like illegal stuff, but they just over leveraged themselves quite a bit. And again, you have the same sort of kind of panic and sell in the crypto markets that you got back then. And so again, for me, I have it priced in that Bitcoin probably continues lower. Maybe as low as 9,000 is kind of my key target right now. But once it gets there, I think it's going to coincide with regulation coming out. And then I think you actually start to see a move back up in Bitcoin. For me, it is a 2023 bottom. I've priced it out right now where it would be about May or June. And I'm doing that based off of the FTX debacle, matching it with Lehman Brothers. Lehman Brothers, the S&P fell for another 6 months and dropped about 45% from that event. And so if we have that same sort of shock to the system in crypto with FTX, and from that date, 6 months out puts us in May or June of 2023, and 45%-ish from approximately when it happened puts us just below 10,000, around that 9,000 marker. Now, there is always the possibility it could go even lower. The worst case would be like 3,500 on Bitcoin, and then it would match up with Amazon's collapse in the .com. Amazon dropped 95% in the .com collapse, and that would put it on par. But that would be like a worst case scenario where regulation doesn't come out. And for the most part, I think you will get regulation. And so it will draw in some bigger money at that point at 9,000. 2023 for me, I'm going to pick gold again. And I don't like repeating myself, but if it's going to be the best performer, it's the best performer. I think that in 2023, gold will outperform. My guess is in 2024, Bitcoin will be the best performer. I think the stock market likely is going to be mired in a multi-year recession. So stocks will likely struggle for the next 2 or 3 years. I actually don't even see new all-time highs in the S&P and the NASDAQ, probably for 10 to 15 years, which is kind of scary. But remember, you're coming out of this massive liquidity craze. And if you go to the .com collapse, it took the NASDAQ 15 years to make new all-time highs. So it's going to be a swing trader stock market, investors gold market, and then probably eventually a bottom picking Bitcoin market. The dollar was so strong in 2022 that it basically took the wind out of the sails in gold. Now, I still think gold, again, if you compare it to the S&P 500 or Bitcoin, it was an amazing performer. In fact, I think we'd all rather have just had our money in gold this year versus any of those other assets. So I think that's the positive of it. I do think now that the Fed is kind of beginning to waver a little on these 75 basis point hikes and likely they did 50, they'll probably do 25 and then maybe pause. That's going to continue to keep the dollar under pressure, which means gold in 2023 should be a great performer. Investors have to recognize that, the labor market has stayed strong at this point, but I do think that there's a cliff dive coming in that sense. So I do think the Fed will hike at least one more time, probably in early 2023. If we look at the symmetry of their moves, they did a 25 basis point hike, then a 50, then 475s, and they've done a 50. So they're almost coming down the mountainside where it leaves them at least 25 more basis points. I think that one of the reasons why the labor market has stayed so strong is that businesses, and generally small businesses, have been very reluctant to lay people off because it was so hard to find employees, right? So when you struggle to find employees, which is what happened over the last year or two, you're very, hesitant to say, okay, well, the business is slowing right now, so I'm just going to lay everyone off. You say, well, what if it picks up? How am I going to find a good quality employee again? And so I think that's what you're dealing with right now, which is why the labor market has stayed so tough. But I do think there will be a point where even small businesses, and we've seen this, we've seen Meta lay off a ton. We've seen Google announce layoffs. I mean, the big companies that understand business cycles, they are laying off. It's just waiting to come to the small business side. And I think in 2023, we're going to see that. And the Fed will basically stop hiking rates after one or two more hikes. Now, the key here is this, is that the Fed, because they were off sides and called inflation transitory and they got behind the curve, they're going to be unbelievably hesitant to lower rates. They're going to hang on and say, listen, we don't want to lower too early. We don't want to create more inflation. And so I think they're going to wait too long to stimulate, and we're going to have a very, very tough recession by the second half of 2023. There's no doubt about it that the Russia invasion, the supply chain, I mean, different things like that created additional headaches for the Fed. But, you know, if you're just looking at them bringing down inflation, yeah, I mean, you give them a good mark for that. But you also have to ask yourself, why was inflation such an issue? Could it be that they printed trillions of dollars and had interest rates at zero for so long a period? I would tend to agree. And I think that, you know, it's easy to say, oh, they get a B plus or an A for getting it under control. But it's like, well, they are the ones that created the problem in general in the first place, right? So again, that's a tricky one. But this is the kicker on inflation, is that bringing inflation from 9% down to 5 or 4%, that's the easy work. That's like, you know, if you have to run a mile, maybe the first half, 3/4 of the mile, we're all doing all right. It's the last little bit from 4% to 2% that I think is going to be unbelievably hard to get to. And that's going to make it very hard for the Fed to stimulate in the future. If we look at the charts here, this is the S&P 500. And the first thing I go to is this trend line here. If you connect this high to this high here, which is the last two, the highest pivot, the all-time high and the secondary high, and just stretch that down, the market has had very much trouble getting through that line. And you can see that again, in the near term, we're starting to break down again from that level. So to me, I look at this market and I say, okay, has the market fully factored in a recession? Has it fully factored in the fact that it's going to be a longer recession? If you think about it too, the economy has been in overgrowth mode for such a long time due to stimulus. It means that we almost need a long period of undergrowth to bring it back to the mean, right? That the average for the longer term growth. So I have it penciled in that probably in the first quarter of 2023, we're going to head down to about 3,400 on the S&P 500, which brings us to the pre-COVID high just before the big dip on COVID. And then I actually think that there's a longer trend line here that we can actually go back literally years. And I think this will be my target for 2023, that I do think we visit this 3,000 level on the S&P. So that puts us down 20 to 25% from current levels. And I think, again, that's really where I would start to get interested, maybe potentially buying a little bit. There's obviously a recession for some people. I think lower middle income with inflation, I mean, they're hurting. There's no doubt about it. Now that the stock market has come in, crypto's obviously collapsed. I think that creates more pressure on middle and upper income individuals that have investments as well. But again, GDP came in. It was just revised the other day for this quarter or the past quarter, and that was actually very, very strong. So I don't think per the norm we're officially in a recession, but I do think we will get to that point in 2023. And I think it's going to be one of those scenarios where the Fed is kind of saying, oh, the labor market's still good. This is still good. This is still good. And I really think it's going to be very sudden where we fall off a cliff. If you look at delinquencies in loans, car loans, housing has collapsed. Remember how many jobs houses fuel, building houses. You got plumbers, electricians, builders, roofers. All of these things are just grinding to a halt. And people had a lot of money saved during COVID. So they were saying, okay, well, I'm okay for now, but there will be a cutoff. There will be a cliff dive at some point in 2023. I've been a trader for 20 years. So for me in this market, I'm what I call a swing trader, which means when the markets flush sharply, I buy key technical levels and then I don't stick around too long. I might hold it for a day, a couple days, a couple weeks, but I'm looking to sell into the pop, as in bear markets, we ultimately will go lower. So I think that's one type of investing, but it's not for everyone. Needless to say, if you work a 9 to 5, it's very hard to follow the markets very closely. So I think if you're that type of investor, you start looking for safe assets, right? You kind of move move your money into maybe a little bit of gold, a little bit of silver, where in the very least it'll be protected. And I think even gold could give us a return in 2023. And I even think there will be a point where some assets, maybe a very small percentage, can go into Bitcoin when it finally bottoms out. I do anticipate a bottom in 2023, finally, in that asset. Again, how much it goes up from there, we'll have to see. But I think that, again, each person has to kind of think about from themselves. But I definitely wouldn't be like buying every dip right now in Apple or any of these others. Understand that bear markets get uglier, and we're just in probably the beginning stages of it.